Looks like we are live. Okay, welcome to the Einstein Retirement Daily podcast. We do want to invite you to enjoy this podcast, but we do not invite you to consider anything in our podcast to be construed as specific investment, tax, or legal advice. Should you get an idea, because obviously we have many wonderful ideas, but should you get an idea from what we talk about today that causes you to want to take some action, whether that action would be legal, investment action, tax action, we do strongly advise and in fact insist that you speak with a professional before implementing any of the things or ideas that we would talk about in this podcast. You need to get some advice from somebody who knows your specific situation. Nothing that we talk about should be construed as specific advice, and so you should get some specific consultation to your specific circumstance before you take any action on anything that we talk about. Okay, what we're going to spend a little time on is focusing on some things that are in the news that are affecting things that is important to retirees, like investments and stock performance and that sort of thing. In the news right now is a very big deal, something that's being talked about a lot for understandable reasons, is going to be inflation. So there was a spike in the yield curve, okay, which is part of this inflation fear and risk, but there was a spike in the yield curve, and it hit over 1.7 yesterday. That would have been on May the 12th, and it hit 1.7. The last time that happened was back in March, and the last time before that was in January of 2020. So this could make fixed income investing interesting. If you're not sure how yields, especially 10-year Treasury yield, can affect our fixed income investments, so these would be things like bonds, preferred stocks, that sort of thing. What you can expect from fixed income investments if yields, especially on the 10-year Treasury yield, start ticking up, is higher interest rates, which also creates price volatility in bonds. Specifically, if interest rates go up, negative volatility in bonds. And so that could create a lot of activity and make a very interesting fixed income investment world. So if you are looking for trying to improve your bond portfolios and things like that, just be aware that there's a lot going on there that could make that side of your investment portfolio, we'll say, I want to use the phrase topsy-turvy, but I don't know if that's the best one. But it's just going to be a little bit of a wild situation if we do in fact get into a rising interest rate period. Now, this is especially interesting as it was in March, because this has nothing to do with what the Federal Reserve System has done. If anything, the Federal Reserve System has continued to put downward pressure on interest rates, not releasing that interest rate and letting it go up. Fed funds rate has remained the same, and so we see things like the prime rate, which was 3.25 last month, and as of yesterday it was 3.25. Last month it was 3.25. 1 year ago it was 3.25. So the prime rate is very low and has remained somewhat stable with some fluctuations, but mostly has remained pretty stable. The prime rate is going to affect things like loans that you would take, whether that be for auto loans, home mortgage loans. A lot of it's going to be based on the Fed funds rate and the prime rate. So no big movements there. This is actually a flow of funds issue and market demand issue that's creating price volatility and movement in things like the 10-year Treasury yield. Also in the news, related to some of these factors with interest rates and the combination of interest rates and inflation, Fox Business did an interview with Peter Maurici, and he is an economics professor at the University of Maryland. I was fairly impressed by this interview. I often don't like interviews on the news because what can you really discuss in a 2-minute clip? But he highlighted some of the key issues and concerns, especially that we would have at Einstein Retirement Workshops. Some of the key concerns that we would have with things like inflation. So he described it as an extraordinary tax on the elderly. That's not a bad description. Okay, I don't dislike that description, because the idea is that the majority of retirees are going to have a good chunk or the bulk of their savings in interest-bearing types of accounts. Well, an interest-bearing type of account is going to be an account that is earning interest based on things like a 10-year Treasury yield at 1.7 and tied to investments that are generating yield from things like a prime rate at 3.25. Well, if inflation kicks up to any serious levels, which it has, okay, so inflation, the big concern is that inflation actually went up by, and is on track to go up by more than 4% this year, which is a pretty big increase. If you've been following inflation or you're on Social Security, you know that inflation has not been anywhere close to that over the last several years. And so to get up into this 4% or higher range in inflation, that creates some concern, especially for those who are in investments or interest-bearing types of accounts that are generating 1 and 2%. So if you're earning 1 and 2% on your savings, but inflation is 4%, describing that as an extraordinary tax on the elderly is, again, maybe not the worst description. That might be a fine way to say it. So the other thing that he said, Professor Maurici, one of the things he said, I'm going to read this quote, he said that the Biden administration has duped the Fed into thinking they can print as much money as they like and it won't have consequences. I don't think anyone's duping the Fed. With respect to Professor Maurici, this was the point at which I was wondering if this is just a Fox News contributor. So I wouldn't get too excited about that. I wouldn't say that there's anything surprising about this to the Federal Reserve, or that they've somehow been tricked or deceived. I don't think that's true at all. But there is a strain of monetary theory, monetary policy, that's called modern monetary theory. And modern monetary theory does have a different take on things like debt and inflation and taxes than maybe what you or I would have as regular, normal lay people. And so I don't think Professor Maurici's description as duping the Fed is maybe the best idea, but it is clear that the Biden administration is fully adopting modern monetary theory principles and how that relates to things like debt, inflation, and that. Another Fox Business article by Jonathan Gerber did highlight that one of the big areas of inflation is actually in used cars. So used car and truck prices rose 10% last month, and that was a big increase, but it's up 21% since 1 year ago. Now, you would say, well, okay, but the pandemic was a year ago, so 21%, is that really that big a deal? Well, yes, it's still that big of a deal, okay, because 21% increase is high even if we had a big pullback last year. So the 4.2% increase in the Consumer Price Index, okay, that's the Cpi Index that measures inflation. So we've had a year-over-year 4.2 increase in the CPI, Consumer Price Index, This jump was accounted for 1/3, according to the Fox Business article by Jonathan Garber. 1/3 of that increase was from used cars and trucks. So that's pretty amazing that the auto industry is accounting for such a massive amount of this CPI increase. This should not be a big surprise, okay? The reason why it shouldn't be a big surprise is because when you think about how we inflate our currency, how do we get money into our financial system? Well, we do it primarily through the creation of debt. Where is it easy for the average person, the average consumer, to get loans, to increase their debt load? Well, you have things like credit cards, obviously, but that's always been a problem. But that's fairly expensive as well and is somewhat cost prohibitive. So you're going to have many people who are going to shy away from things like credit cards as a way to increase their personal amount of money, their own personal money supply, increasing to the total money supply. So why auto loans? If you have gotten a car recently and looked at the rates, how many 0% offers are there? How many 2%, 1% offers are there? There's a lot. Auto loans are very inexpensive loans. Consider also like the stimulus checks. Stimulus checks are part of cash flow. Cash flow is a metric that is used to determine eligibility for a loan. So if you have eligibility for a loan that is coming from your income, and your income is higher, even though that may be a stimulus check, it often doesn't matter, so they still will approve these loans. Especially in the auto loan industry, it's not regulated like a mortgage. So easy access to credit, cash flow being a primary requirement, a lot of people having cash flow, especially from things like stimulus checks, that allows people to borrow money and put upward pressure. If you have more dollars, even if it's loaned dollars, competing for the same goods and services, limited number supply of automobiles, that is going to create inflation. And so it's not a surprise that we're seeing things like automobile costs be such a major part of this inflation issue. Okay, Barron's has maybe another take that's sounds somewhat dire compared to this, more just sticking to the facts, we'll say. Barron's article by Al Root describes the increase in auto prices as a bubble. Okay, he cites Sean Darby from Jefferies and Company, and he's describing it as, now not only are we just seeing an increase in prices, but there's concern that this is a bubble. If you're not familiar with the bubble concept works like this. You blow up air into a balloon and it creates a bubble, meaning the balloon blows up, but you're forcing air into the system, okay? Or you're forcing, say, whether that's air, in this case it's dollars, you're forcing extra dollars into a system that doesn't really have the capacity, and so you're creating a bubble, meaning overpricing, because there's free money or excess money into that particular segment of the economy or goods and services. So if in fact this is a bubble, if Sean Darby is correct, then this is going to be something to watch for, because bubbles tend to pop, unfortunately, and that creates pretty dramatic swings and dramatic reactions in prices. CNBC has a slightly different take on this inflation issue. In an article by Patty Dom, she suggests that everything is under control. This is exactly what the Federal Reserve wants, and this spike is temporary. Now, she does highlight that some people are are saying that, well, the Fed could be wrong. Maybe it's not just temporary. But if you read the article, mostly it seems that people are thinking that it's temporary, and the Fed is pushing that idea, and we'll see. This is a short-term inflation pop, but it's not going to last. So I want to give you my take on inflation, and inflation is best understood. I'm going to give you a very simple analogy that I think does a very good job of explaining what is inflation. So imagine for a minute that you have 5 M&Ms. Okay, you have 5 M&Ms in your hand. I hope you like M&Ms because that'll make the analogy better. If you don't like M&Ms, use your own thing. Okay, maybe you're a health nut. You have 5 pieces of broccoli that are beautifully seasoned. However you want to do it. But let's go with the M&Ms. 5 M&Ms is what you have in your hand. I come along and I say, hey, would you mind sharing? I'd like an M&M. And you say, well, I don't know. I only have 5. Now let's say you have 10 M&Ms. And I come by and I say, hey, do you mind if I have an M&M? And you say, yeah, sure. How about 2? Why? Why is that how it works? The M&M is not more or less intrinsically valuable. The M&M itself holds the same value. The issue is that you have more of them. When you have more of something, you value it less. The same is true with dollars and money supply. As we increase our money supply, we are devaluing the money supply and therefore increasing inflation. Because you value your dollars less because you have more of them, you're willing to spend more of them on goods and services. That competition of dollars competing for goods and services leads to inflation. Very simple description. Why does it not exactly work like that in our real economy? Because if you were to look at a money supply chart, you'd say, holy smokes, money supply has gone up way more than inflation has. Why is that? Why is it that money supply is not keeping up? Or excuse me, why is it that inflation is not keeping up with money supply? Kyle, if you were correct, if your description was correct, we'd see much higher inflation than what we've seen. So what gives? Well, the problem with the way that we create money supply, the way that we increase the money supply in our country, is that we increase money supply primarily, again, through debt. So this is what I mentioned a minute ago. So where have we seen inflation that more closely mirrors the increase in the money supply? Who's borrowing the money to increase the money supply that's leading to these higher inflation rates, and where are they exactly? Well, if you consider automobile prices, you're going to get closer. If you're going to consider education prices are funded largely by student loans. Loans, free money injected into the system from money supply, government-backed, lower interest rates. So, education, much more closely linked to the increase in the money supply. Where else? How about the stock market? Do big stock companies borrow money to purchase back their own stock? Go dig into that one. Okay, what about mortgages, home prices? Have home prices more closely been linked to the increase in the money supply? Okay, see, if you start looking for where the money supply actually is increased, where do the dollars come into the financial system, then you can start to see where this inflation factor, this 5 M&Ms turning into 10 M&Ms, actually shows up. Okay, this brings us to another article from MarketWatch where they have described, and I'll put the link in the comments or the description, because I forgot to write down the author's name here, but I'll put it in the description, where again the 4% rule is under attack. So this idea that Retirees can spend 4% of their savings every year, increasing with inflation, and they're very likely not to run out of money if they do it like that. So Jack DeJong is quoted as saying that the 4% rule is likely to fail for someone who retired in the year 2000. Between the lost decade stock performance, so that's from the end of 99 to the end of 2009, that's the lost decade, 10 years of negative S&P 500 performance. And the combination of that and our current low interest rate and low fixed income yield position is going to cause those who retired back in the year 2000 to maybe experience more difficulty than they would otherwise have. This article is described as something like a worst case scenario. I don't think that's the worst case scenario. Okay, so some of you have heard me talk about this if you've interacted with us in other settings. My worst case scenario for today's retiree, and it's something I'd encourage you to really think through, how can you manage this, is 3 simultaneous issues. Number 1 is already here. We're in a low interest rate environment, and to some degree the Federal Reserve's hands are tied. They're not really in a good position to be able to increase those interest rates. And in fact, it could create some pretty good sized havoc if they were to try. The second is, what if we're in the next lost decade and we don't realize it yet? The problem with the lost decade is you don't know till you look back and you see, oh, holy smokes, over the last 10 years we didn't go anywhere. Okay, so you need to be mindful of that when you're thinking about your stock market performance. Are we in another lost decade type of scenario? So if we have another lost decade and interest rates stay where they are, and here's the big one, something we haven't seen in times past, but we have now today, because interest rates are true today, but they weren't back in 2000. Interest rates were pretty decent then. But today, interest rates are already low, and what if we end up in high inflation? Low interest rates, high inflation, and bad stock market performance, that's a worst case scenario that I think is complex enough to capture what we need to be considering and thinking about when it comes to these issues of retirement readiness and having things set up for you to get through retirement safely. So we're a little bit in uncharted territory for those reasons. Now, one solution to some of these investing difficulties that we're in that has been written about somewhat extensively, and it's a little counterintuitive. It's counter the, we'll call it traditional wisdom, but nevertheless is certainly relevant, and maybe even more relevant today than it was when the research was first done back in 2013. And that is some research by Dr. Wade Pfau and Michael Kitces that is called the Rising Equity Glide Path. So the Rising Equity Glide Path was first published in the Journal for Financial Planning, again in 2013, and highlights how you can manage these issues of potential bad or difficult stock market performance, combination with a low interest rate environment, combination with the problem of the potential for high inflation. And so the Rising Equity Glide Path is something that is not an easy rule of thumb. But I would say, you know, a lot of people misquote and mischaracterize Dr. William, I want to say Bremen or Brennan, I can't remember now. But his research is the one that came up with the 4% rule. And it was a little simple, but it's not as simple as people say. Okay, so a characterization that his ideas are all simple, I'd say is very unfair and would be a mischaracterization. So be very careful when you hear that there's simple rules like a 4% rule. I would not say that that's simple at all. In fact, Dr. Bremen recently published an article that described the intricacies of developing a robust spending plan and the importance of managing a actively attended to spending plan based upon current market conditions and current economic conditions, and how that should be very attended to closely with a qualified professional. So his research and his ideas are not simple, and sometimes I feel that he gets a little bit of a bad rap because he's blamed for the 4% rule, which I think gets we'll call it debunked about every month. Somebody comes out and says, hey, wait a second, if this, and this happen, the 4% rule is going to blow up. Well, he would agree with all of that, so it's not his fault. We should be a little more cognizant of that. His ideas, again, were not there to decide how an average person should do things. He wrote that actually as guidance for a financial planner to think about with his clients, but thereby attending to his clients' specific needs. So do be aware of that when you're thinking about these types of rules. Anyone who says that there's a simple rule either is quoting something that never has been in the research, or they just don't understand. It's not quite as simple as they're saying. So just keep that in mind. Okay, I am going to put all the articles that were referenced in today's show in the description section of YouTube. I encourage you to check those out. If you're not already familiar, we would like to invite you to attend one of our hour-long retirement planning workshops. To find them, you can simply visit our Facebook page, send us a message there, and we'll be happy to get you signed up for one. Or you can subscribe to our YouTube channel, follow our Facebook page, and you'll be notified whenever we launch a new event. And that's all for today, and we'll look forward to seeing you next time.